Welcome, everyone. Thank you for joining us for the Collaborative Innovation Webinar Series presented by Business Innovation Brief in partnership with Innovation Enterprise. We want to thank RocketSpace for sponsoring the webinar series and helping us to make this happen. If you haven't heard of RocketSpace, they are helping some of the largest corporations around the world expand their innovation pipeline through startup partnerships and collaborative industry accelerator programs. For registrants of this webinar series, RocketSpace will provide a free copy of their disruption report that includes the top trends of 2017 in startups within the following tech themes: communication, customer experience, connectivity, IoT, and mobility and transportation. So thanks again to RocketSpace. My name is Chris Bechtel, and I will be your host today for this webinar. Our goal is to keep you up to date with the latest trends, best practices, and case studies in corporate innovation. Over the next few months, you'll have the opportunity to participate in 4 additional webinars. This is the second one in our series from top-rated speakers covering topics critical to success today. As mentioned in the registration, we are recording these sessions and we'll make them available to you, complete with a copy of the slides. We will send those to you, within a day or so of today's event. So if you've missed anything, you can re-review it. Of course, we'd love it if you'd share it with a colleague and reference it again. So I would encourage you, even of course, as we are recording these webinars, to attend as many of them as you can, so you can ask your questions directly and get immediate insight from our terrific lineup of speakers. So on that note, definitely today, please feel free to ask questions during today's session. You can do so by submitting them into the chat on the left side of your screen. We will endeavor to answer as many of them as we can. We will have a Q&A at the end of the presentation, about 10 minutes worth. Also, another little housekeeping note, if you do experience any audio issues today during the webinar, you can try and switch to phone. Sometimes you have a better experience by dialing in on your phone, and you can do so by choosing the More button in the upper right corner of your screen and then switch to phone, and you will get the dial-in info. So now I'd like to introduce our first speaker. And of course, I mentioned RocketSpace earlier. And again, I would encourage all of you to learn more about RocketSpace. And our first speaker today is Kenice Wu, who's an expert on startup partnerships. Kenice is currently the VP of the Startup Engagement Program at RocketSpace. He's a serial entrepreneur and investor, and Kenice leverages operating experience and network to establish market leaders. Over 27 years of experience in the founding, operating, investing, and scaling of successful companies with deep technology in big data, software as a service, mobile, and innovation. I'm pleased to have Kenice with us today. Thanks for joining us, Kenice.
Well, thank you, Chris. Thank you very much. And thank you so much for the introduction. I just want to spend perhaps the first few minutes to give you a brief overview of RocketSpace. So RocketSpace, our mission is to really help innovators really focus on accelerating their velocity. And the way we think of velocity is both speed as well as direction. And we think of innovators really both for startups as well as for corporations as well. On the startup side, we offer our technology campus, which really encompasses not only facilities, but also our community, our ecosystem, a number of great events, as well as our access to network such as VCs and investors, as well as corporations. And for corporations, we provide services including consulting services, as well as accelerators that really help connect corporation and startups together. We have been very fortunate to have really worked with some great companies over the past few years. Over the last 6 years of RocketSpace, on campus, we have worked over 1,000 startups, of which over 92% are still in operations today, which is a very, very high threshold, shall we say. And also, out of the 1,000, we have worked with over 17 unicorns, in which includes Uber, which actually started right here at RocketSpace just a mere 6 years ago. And we also have worked with a number of other unicorns such as Supercell, Spotify, etc. And for the corporations who have also worked with over 150 plus of the Fortune 500 companies globally across numerous industries, such as Anheuser-Busch, Nestle, British Petroleum, Pfizer, Lufthansa, and so on and so forth. And next, I'd like to perhaps describe a bit in terms of our methodology on corporate innovation, where, again, our focus is for helping corporations that are seeking innovation and disruptive opportunities, and startups that are looking for opportunity to access market and scale. And the way we do that is really can be explained in these 4 phases, if you will, in a methodology in terms of learn, discover, experiment, and partner. Learn is really a product innovation strategy where we work with our corporate partners to really identify what we call the opportunity space for innovation and disruption. With that, we use that as kind of a map to discover, where we really scout the world and discover and identify the best companies, startups, as the best match for that particular corporation's needs. After discovery, very important is to then go on and experiment. And this is where we assist our corporates and startups through proof of concept and pilots to ensure that this is really a fantastic fit. I call it ticket for a test drive. And then finally, once we agree that it's a good partnership, then you got to go through the partner phase, which is we actually, again, help startups and corporate identify the best form of partnership, best way to align the businesses together, and also help with capital structure to move this forward along. So with that, I just want to turn it back over to Chris. Thank you.
Terrific, Kanish. Thank you so much. And now I'd like to introduce our next speaker, who's going to join Kanish shortly in a dynamic Q&A, and we're going to talk about, of course, collaborative innovation in the enterprise. And so I'd like to introduce Paul Campbell, who's an expert on corporate entrepreneurship. Paul is currently the SVP Innovation at Royal Philips Electronics, responsible for its accelerator, open innovation, and emerging business programs. He's also the CEO of Startup Genie, a consulting firm which perfects corporate entrepreneur programs, co-founder of the Silicon Valley Innovation Executive Group, and a guest lecturer at UC Berkeley Haas and other universities in Silicon Valley and Europe. Welcome, Paul. Thanks for joining us today.
Thank you, Chris. Looks like there's a question on the post that some people are not able to see the slides. I don't know if there's an adjustment that needs to be made, but if you guys could look at that. It looks like the bio I sent you was a little bit out of date. I'm currently the SVP of Innovation at Schneider Electric, previously at Philips, previously at HP in the Valley in similar roles. And what I wanted to do was just introduce to everyone Schneider Electric. We are about a $30 billion Paris-based energy technology and automation company, and we are focused, the world's leader in energy distribution. We help protect people and equipment from the bad things that happen when they come in contact with too much electricity, and that's our specialty. It's a business which is driven by codes and regulations, and so it's a highly conservative and regulated environment. So for us, we felt it was an interesting story to talk about sort of how we are revamping the innovation program here at Schneider. We hope you find it to be true. Our businesses are in data centers and networks, smart buildings, smart infrastructure like smart grids, smart cities, and smart factories, and also in our automation business, a large percentage of our business is in helping make industrial factories and automation and production lines more automated through things like PLCs and the like. Just to build on my background just a little bit more, I joined Schneider 3 years ago, previously at Philips and HP, where my teams had helped HP and Philips get on Fast Company's most innovative companies list. Fast Company has been publishing this list for 10 years, and in 4 of those years, my companies have made the list, in part because of the things that we were doing in my innovation team. So when I joined Schneider, they said, hey, we want one of those. And we haven't reached that yet, but we are getting recognition from industry leaders like CB Insights, who saw, who we met with. I met with Anand Sanwal, the CEO of CB Insights recently, who said, "Wow, you guys are 4 to 5 times above the best-in-class level in forming partnerships with startups." So just a quick overview so that you gain a little bit about sort of the context for our conversation. So, Chris, back to you.
Terrific. Thanks, Paul. And yeah, apologies about getting the bio wrong there. I was wondering anyway, but yes. So Paul is, of course, with Schneider Electric, and appreciate the intro from both of you. And so now I'd love to bring Kanice back on. And so you guys, again, we have a number of topics here for everyone on the webinar that we think are critically relevant to all of you today and what's happening. And so I'd love to bring Kanice back in to kind of talk with Paul about, some of the various corporate innovation models. Kanice?
Thank you, Chris. Thank you so much. And thank you, Paul, for the introduction. And I've known Paul for a few years now, and he's really a wealth of knowledge here. And also, Paul has really been in this corporate innovation space, if you will, way even before Schneider, and been literally decades, where you may be one of the founding thought leaders of this industry. But I would love to maybe start with maybe a very broad question, which is, you've been looking at this for a long time. What really have you seen that has really evolved over the years, perhaps maybe over the last decade in the area of corporate innovation?
Yeah, so good question, Kanice. We could probably spend the whole webinar on just that topic. There's been so much change, and I've been in this space of corporate entrepreneurship and innovation for 15, 18 years, and all at large companies, helping to revamp their innovation programs to make them more agile, fast, finding new opportunities and finding new sources of growth. So I think some things in the last 10 years, 8 or 10 years that really stand out is the digital transformation that corporations are going through today, and the stress that's putting on those corporations. So you take a company like a Schneider and its peer group of Siemens and ABB and GE and Eaton. We're old line manufacturing companies which make products, and we ship those products through wholesalers and distributors. And now with the digital transformation, all those products, the expectation is that those products will be connected, that there will be sensors connected to them. There will be this IoT stack laid on top of the hardware. And that's creating a lot of stress for everybody in old line industries, because you're having to place more resources on things that you don't necessarily have, the skills internally to deliver. So to answer your question, then what's that's forcing most corporations to do is to look outside, to find partnerships with innovative startups and companies who can provide that IoT stack or pieces of that IoT stack to help create the solutions that their customers, that our customers are asking for. And so whether it's the low cost of sensors, and edge devices, or the access of low cost cloud, this is all creating, of course, as many people on the phone already know, is creating a huge disruption to traditional businesses, and therefore corporations are looking outside, and we're finding great startups with great talent, and with the skills that corporations don't have to really address this opportunity in digital transformation.
Thank you for that, Paul. I mean, that's really a very kind of important point in terms of digital transformation. So how does corporations, perhaps maybe Schneider is a great example in terms of how do you balance, where you place investments in terms of, there's still some very heavy assets, so to speak, but then there's also the whole digital transformation side.
Yeah, so we kind of look at the gaps in our roadmap, or gaps in our solution stack, and to oversimplify it, it becomes a make versus buy decision. We can make it ourselves, or we can work with external partners, and so what we are doing is looking at our portfolio and our roadmaps and seeing where we need to go strategically to get ahead and win in certain business areas, and then working with partners and scouting partners along those themes, and finding the best and partnering with the best. So we are placing a bigger sort of investment in those external partnerships than ever before.
Got it. Thank you for that. And as you think about these external partnerships, I mean, this is perhaps maybe a very broad question in terms of what kind of innovation models have you used that you found has been more effective? Yeah.
Well, so a couple things. So, when I first set up the innovation center in Silicon Valley, it was 3 years ago. It was an innovation center of one. We had an ambitious name for a desk in rocket space, but what we wanted to build it slowly, and many corporations who think about putting innovation centers in innovation cluster areas, whether it's Silicon Valley or Israel or Bangalore or Shanghai, they want to think about starting small and then building the team and the program as projects are identified and opportunities are identified or acquisitions are made. So when we built this, and one of the first models was really try to leverage the expertise in this case of rocket space to tap into the startups that they knew, their network, and ask for help to find the best ones along one of those themes. Then the model that we put in place was having what I call an internal accelerator, but it's a team of a few resources who are able to champion that startup relationship and help to onboard that startup with our core lines of business. Like most companies, we have our central program and functions, and then we have core lines of business who own the P&L. And ultimately, those business units with the P&Ls are the ones who decide where to place the bets on startups and internal development. And so that can be challenging at times, but we found that by having champions who really champion the startup and work with the line of business to make sure that there's a good match and a good fit, that helps us make a better fit and more likelihood for success. So getting help outside with service providers and really focusing a few resources inside to make those partnerships successful has made a big difference.
Got it. I see. So, and in your programs, if you're right, both there's internal accelerators, and as you work with other partners, would love to maybe get your thoughts on what was kind of the core focus or objectives in for Schneider Electric in working with startups, if you're right, and what was some of the outcomes of that?
Yeah, we had, I would say, probably three. One is filling gaps in our roadmap, as I had mentioned already. Second is moving into adjacent areas. One of the things that we have sort of an outcome is that we found, we were pretty skeptical when we started. I mean, this is electricity, right? This is highly regulated. There's not startups out there working in this space. It couldn't possibly be true. And then as we started getting, as Rocket Space helped us find companies, we couldn't believe really how many startups were working in maybe not our core business, but related areas. And so one of the big values has been the ability with partnering with startups to move into adjacent areas that either we didn't put on our roadmap yet and was a little bit farther out, or that we didn't even recognize. And so that moving into adjacent areas and finding new growth opportunities is one of the biggest values. And I think the third area, filling gaps in the roadmap, is one. Moving into adjacent areas is two, and the third is finding disruptive technology, whether it's a product or a business model or an IP. I met with a startup just 2 weeks ago who was doing things that we tried to do 10 years ago, and in the last 2.5 years, they've done it, and we couldn't do it. So, and it's very disruptive. So it's great when you find, just amazing things happening in your own business. and then being able to turn that into revenue potential or cost down, reducing costs of the operation. And the third sort of value and benefit is sort of innovation value, right? I mean, if we're going to make the Fast Company list of most innovative companies, we need to be able to commercialize and turn those startup opportunities into big innovation areas for both companies.
Great. I think you definitely getting into I think one of the topics, which is challenges in innovation, right? And perhaps we should just dive right into that one, which is you mentioned in terms of basically having central program and working with the various different parts of the business. And so love to get your advice and thoughts on how you were able to get the internal buy-in or the alignment, if you will, among the various different stakeholders.
Yeah, it's a great question. I probably spend most of my time on that question, Kanice. So the way it works best, and this is the way it worked when we worked, that very first time with RocketSpace is our business leader identified an opportunity, a strategic area, and let's just say smart home, and energy efficient solutions for the smart home. What does that look like in the U.S.? And the business leader was from France, and he didn't know so much about the U.S. market, and he came. And he met with us, and he met with the 10 startups that you guys had helped us find, and he learned so much. And what in that case, it really worked really well. I encourage everybody in this kind of a role to start with what is that strategic opportunity that the business leader has found. Then search for companies that fit that area, and maybe not necessarily just right on point, because you just don't know always in advance where the company or a startup might take you. And so and I love to tell this story because it was so telling for me. We were working on this energy efficient solutions for the smart home project, and Kanice's team introduced us to a bunch of companies. We screened them, and I wanted 10, and we had found 9 after going through it twice, and we couldn't really find a 10th one. And Kanice's team said, Paul, we really like this. You rejected these guys twice, but we really like them. Would you take them and put them on the list? And I said, okay, well, I can't find anybody better, so okay, we put them on as number 10. Guess who the first partner that we signed up was? Number 10. So what I take away from that is that the viewpoint, the perspective of an outsider kind of helping to do some of this work is very valuable, to be able to look at a strategic opportunity from another perspective to help really explore new business models that you may not have thought about, or new opportunities that are emerging that we may not see back in headquarters. So that's an important one, is that strategic kind of fit, and starting there with that alignment. On challenges, let me just comment on that a little bit more. I could talk about speed and impedance mismatch between large company and startup, or I could talk about not embedded here and the resistance that you get and stuff. But I'd like to maybe just spend a minute on the biggest challenge, and probably the insight to share is around this opportunity or this challenge of finding the real synergies with the potential partnership. So, and I say that from a person from who has gone through a lot of partnerships and thought many times on paper, this startup and this company should work really well together, and we should do great things together. And then you do the deal and you get it out there and nothing happens for whatever reason. Maybe not the right fit, maybe not that we don't have access to the right market, maybe we're not talking to the right people, in the company. If we should be talking to the C-suite and we're talking to the operations people, or vice versa. But anyway, on paper it looked great, in practice it didn't. So I'm a big fan of working early on to really identify those expected synergies and how things will work, and then setting up some mile markers that say, yes, we are seeing them, and we're getting them, and we're hitting them, or not. And this is why this is why, and that's a very important part. And I'm happy to spend more time on that, Kenise, if you like. But for me,
please go ahead. This is really so important.
The real success. I talked to a colleague at GE and other companies. I've talked to talked to a lot of people in many different companies, and many of them say, we have venturing and we invest in companies and we acquire companies, but that's it, right? And then we expect the organizations to figure out how to work together. And many companies don't have this kind of try before you buy approach, right? And so if you can find a way within the organization to set up a try before you buy, so find a way to pilot, to do a proof of concept, get it, practice lean innovation, get it in front of your customers, get the feedback, and see that initial success and validate that, and then say, okay, now let's do a formal, scale up agreement, and let's do something more, more serious. But getting that sort of synergies, finding those synergies and validating those synergies between the two companies is probably, the biggest area for success.
So, sorry, Paul. I think this is. What sometimes we've seen is, particularly in terms of you mentioned, teeing up a partnership and nothing happens, and I've seen this a lot as well, right? And sometimes what I've seen is for corporates, they put the best minds on finding the right company and doing the deal, so to speak. And then once the deal is done, whatever the deal might be, whether it's an investment or partnership, then it's left to the line of business. Okay, go make something happen, right? And some of the brightest minds moves on to the next project, so to speak. And that's where sometimes as you mentioned, either nothing happens or the wheel starts falling off the car here or the vehicle. But how do you make sure that it stays on the forefront of some of the perhaps the most important people and stakeholders in an organization to really drive real value and the synergy out of that?
Yeah, it's a great question. I think we like to joke that the scouting startups is the easy part, right? The hard part is actually operationalizing that partnership. So you're exactly right, and what you're seeing is I would agree with you that's certainly from my experience the biggest challenge. So if we go back to this idea that you start with a strategic alignment, a strategy, an opportunity that the business leader and the open innovation team align on, then you find startups and you find promising ones, then what's the heavy lifting that comes next? How do you form that partnership? So in the case in cases of success that I've worked on, we've had either a champion identified on my team or a champion identified in the business unit team to onboard startups, or both. And in both cases, the point for that champion, especially in the line of business, in the business unit, the champion is responsible for onboarding the startup and doing all the things to that partnership that the line of business expects. Every large company has multiple lines of businesses. We have 40, and each line of business acts independently for the most part, has their own process. And there's a lot of commonality, but there's a lot of individual process. So understanding 40 different approaches to working with startups is nearly impossible for my team. So I assign dedicated people on my team to work with, say 4 or 5 business units, and they get to know the business unit and understand how they work. So then when they find startups, then we usually start with kind of to your point, we start with sort of a first agreement. One of the things we changed within the company was, in the past we had a 40-page contract, just standard contract that you give to everybody that you're going to work with, 40 pages. And the startups that we've talked with, were pushing back, saying, this is going to cost a lot of money and time, and just to go through this silly thing. So we changed that to a 4-paragraph contract. So in this first thing, after we sign an NDA, the next thing we sign is an agreement and that sort of lays out how we're going to work together. And then as the partnership grows, so does the contract. So we just add another page and an addendum whenever we need to deal with IP, or whenever we need to deal with how we're going to handle the co-development after we add another page, and you just keep building the contract as your partnership grows. Same thing on the resource side. You start with a person or half a person or part of a person as a champion, and then as the partnership grows, you add more resources. And that's a model that most everyone can appreciate and understand and work with. And at any point if the partnership stalls out or stops, or we realize, hey, the synergies aren't there, let's stop, then we haven't done, we stop and we end it, and there hasn't been a lot of unnecessary work on the contract or hiring resources and putting resources in place that just don't materialize and don't need to continue. So, in that sense, it's like any kind of startup model you add as you grow. So I hope that helps a little bit.
No,
but I call that
terrific,
just to go back to that.
Yeah,
just to go back on that.
Go ahead.
On that point of the 40 pages down to 4 paragraphs. I call that deconstruction. And when I write my book, I'm going to title it Deconstruction, because this whole notion of sort of deconstructing the corporate processes to be able to match the business need at the time is very important. And that's an very simple example of changing our legal and purchasing process, which is never easy inside large companies, changing that to be more agile and flexible.
Great. Well, Paul, I'll be the first in line to buy your book here. No, I'm not even joking on that one. So this is terrific. You call it deconstruction. I think of it as it's kind of a very iterative way of working with startups. I mean, I'm sure we all heard of lean startup and iteration, but breaking even down to the legal arrangement between corporates and startup into that process. That's the first time I heard of it. That is really. You got to write the book anyway. And maybe on that thought, I just thought maybe one more question on challenges here, which is, as you mentioned, right, Schneider Electric and basically a lot of energy is heavily regulated, and also big corporations typically are very, shall we say, risk adverse, right? When we present an opportunity,
as
opposed to looking at how big the opportunity is, what are the risks it adds to the table? How do you help an organization like Schneider get the heads around, dealing with the risk aversion part of that?
Yeah, it's a great question. So, we are, and like many of our peers, we are a 180-year-old company. We are in the highly regulated business, and we're French. So, I can't imagine, a more challenging environment to be able to, try to get some innovation going in Silicon Valley, just because it's distant and remote. And I had the same challenge when I was at Philips, in the Netherlands. When the innovation is a long way away, it's challenging to get the home office bought into what you're doing somewhere else. Anyway, so how to deal with some of that risk. So one of the key things is, I'll go back to that strategic alignment, but sort of understanding that there's a new opportunity that's emerging that's going to generate growth potential for the line of business, helps the line of business to say, okay, I'm willing to put a little money behind this, right? So seeing the opportunity, so sort of envisioning where there's an opportunity. The second is that by having this sort of what I call the accelerator model, this walled garden place where things can happen without much intervention and distraction to the core line of business, creates sort of a much more receptive approach or more receptive audience by the line of business leaders. If they don't have to fund it, they don't have to think about it. All they know is that, okay, if this works, it's going to help me. And many times, that's about as much attention as they're willing to give. So that's why I have a separate budget. I have a separate resource team. I have a separate, and I can fund this activity without tapping into the line of business. And many times that helps line of business, to not say no right up front. The second thing is that the commitment to what I do in that walled garden is that my commitment is that I'm going to figure out answers to all their questions. Maybe I won't figure out all of them, but I probably won't. But as many as we can, so that all the questions that you have are answered, and we de-risk this opportunity. So we understand where the risks are and the risks aren't, what's really true and what's not. And so that by the time we come out of this walled garden, we can pretty much, alleviate the fears and concerns and risks of the business unit manager. So they start, and when we come out of the walled garden, they then we ask them to start funding some of the work to go forward. And so my investment declines, their investment increases, and they're okay with that because they know a lot more about the opportunity at that point. I like to say, if you ask for a financial commitment right up front, that line of business leader doesn't understand the business model, doesn't understand the digital transformation that you're talking about, doesn't understand the market necessarily, and so in this new adjacent area, and so it's very, very difficult for them to understand. I mean, you might as well. I used to work at Philips, where Dutch is the language, and everybody, it's a very, very difficult language, and I never understood it. And I like to say you might as well be speaking Dutch to the person, because they're not going to understand a word that you're saying, because you're talking about a language and an opportunity that they've never heard of before. Perhaps I'm being a little extreme, but by going through the wall, by going through the accelerator, coming out of the other end with lots of questions, and that helps them to understand, feel that the opportunity is more understood and grounded and de-risked, then they are able to be much more confident about starting to apply resources. Does that help?
No, thank you, Paul. That helps a lot. And this kind of walled-off model, I think it's also something that Rocket Space advocates as well. In fact, we also have as I mentioned earlier, we also have an accelerator model. The Rocket Space version is really bring a number of different corporate collaborators together to do these kind of walled-off accelerator, focus on what I call truly industry transformational type of innovation and disruption as well, right? So, yeah, I think we're definitely in sync in terms of that. For the sake of time, I'd like to perhaps move on to a third topic, which is really working with startups. And again, this really gets into the nuts and bolts, if you will, in terms of how does these partnerships really work together. And there's so many questions on this topic, but maybe like to start with a question in terms of what type of characteristics of startups have you found that has been most effective in partnering with Schneider?
That's a great question. We've found a lot of, first of all, sort of identifying startups that come to us with an idea that they have a good alignment to what we do, and we are, as an energy tech and automation company, we're trying to improve how people make better use of their energy. And this has a global reach, right? I mean, the world's use of electricity is going to increase by 50% in the next few decades. We have to reduce carbon by 1/2, and when you do that math, 1.5 divided by 1/2, that means that we have to get 3 times more efficient at using our electricity. 3 times more efficient. It's a global problem. It's a big problem, and everyone is working on this. So there's a lot of startups and that share that sense of urgency and that need to help reduce energy consumption and improve efficiency. So one of the things, and every industry has their sort of vision, and every company has their vision and mission, and companies will, startups will align to that very, very nicely, self-align to that very nicely. And so one of the things, we'd like to, work with startups who share that vision and are really working on solutions that are helping to improve the use of energy, coming up with new business models and the like. So kind of one thing is that shared vision. Another thing is that we've found, startups that are really able to separate sort of their contribution to the partnership and our contribution. It's nice. It's very nice when we have very, very clean sort of separation of responsibilities. It gets very difficult when there's a startup who is working on something that's very, very similar to what we do, or vice versa. Everybody gets a little bit more nervous. We had a recent tour of executives from our energy sector, and our energy sector represents the people who sell protection and distribution gear to oil and gas facilities and mining and utilities. And we really have a lot of solutions there. And we met with a startup, and for the first half of that conversation, we thought we were competitors with each other. We were both working on the same space. And then at some point, they pointed out that they had a solution and that we didn't have, or we recognized that they had something we didn't have. Anyway, the whole conversation changed because we realized that there was a clear need with a gap in our portfolio that they filled, part of their solution filled, and if we can find a way to partner on that one solution to fill our overall portfolio, it's going to be a great partnership. So always kind of the best partners are those where we can find clear lines of separation and collaboration and able to really get everybody comfortable that this is going to be a great partnership where we can build great new businesses together.
Okay, great. And the next question is really really get down to the very pragmatic in terms of how have you found that's been very effective in terms of how you work with startups, right? And you and your group, in terms of what are the things that you look for, and how do you prefer to work with startups?
Yeah, so we like to work very fast, make as many quick decisions as we can about the potential to work together. Where we often run into problems, of course, is when we go to the lines of business and ask for help and clarity and buy-in from them. But we like startups that have some sort of initial market success. They've got a clear definition around who their target market is and what their contribution is, their value prop is, their differentiator is from everybody else. Someone who is really going to, really, as one told me recently, we are trying to disrupt your business. No disrespect, but we're coming after you. and I love that, right? That's great. Because and the point is they've actually found something that is really disruptive and really great. So that's fantastic, and we love that because that's an opportunity for us to look at something that's emerging, that's disruptive, and find a way to partner. So we like that clarity, that disruption, and really have when we first sit down with them, they are saying, here's why we want to partner with Schneider, and so that they've thought through why a partnership with Schneider is valuable for both of us, and making that clear is extremely good. So we're actually doing less attendance at generic pitch days. Because the message is generic and it's trying to appeal to a broader audience, and we much prefer meeting with those pitch day companies one-on-one later, and having sort of that why we can work together discussion. So yeah, that's those are the things that we're looking for, and also I think probably the last thing is just a willingness to really work with us. And understand how we can create something great together. So doing that first proof of concept together, doing that first pilot, and coming up with what that success looks like is very important right up front.
Great. Thank you, Paul. Thank you so much. And now we're going to transition to Q&A. There has been a lot of great questions that's already been queued up, and I'm trying to kind of get through some of them, if you will. So appreciate all the questions. If you have more questions, please keep them coming. But maybe I'll give Paul a quick break for a second, and because there was a question about what is the business model for Rocket Space, and I'll just give you a quick update on that. So Rocket Space corporate innovation is very much a consulting advisory services model, where we do not take equity position in any of the companies. So we remain, I call, fearlessly independent and neutral, and we really serve our corporate clients looking for the best companies that matches what they're looking for. And we really have two different models. There is what we call the startup engagement model, which is a one-on-one model where specifically for a corporate client like Schneider, we will essentially do the learn, discover, experiment partner to really identify and form the best partnership between a corporate client and a set of startups of their choice. Secondly, it's also the industry accelerator model I alluded to earlier, where it's more of a consortium model or the many-to-many model, where we have a number of different corporate collaborators together going through two cohorts a year model, where we will work with a number of startups through their pilot and proof of concept. And we already have a number of them in logistics, in mobility, in food and agriculture called Terra, et cetera. So that's kind of a quick overview of Rocket Space business model. If you have more questions, let us know on that. But more importantly, let's go back to Paul. I hope you had a chance to take a breather here, and number of different questions. So maybe you would just
Hey,
sorry, Paul, go ahead.
Let me just jump in there, because one of the things you said also, one of the reasons that we like working with you guys is we also don't necessarily take equity or invest in startups, certainly not at the front, in part for the same reason, right? We're really trying to work with startups that are going to grow great businesses together. So we like to really focus on that partnership and the synergy potential. We might take warrants or ask for warrants, as part of our in-kind investment in the company. But we also have a venturing arm. But for the most part, we're really looking for access to that innovation. And in a place like Silicon Valley and other places, innovation clusters around the world, capital is the capital markets are so hyper efficient that there's plenty of money, and we would rather just let the markets, capital markets, work their magic, and we work our magic, and then off we go. So anyway, but that's just to build on what you said earlier about equity in startups. Great.
That's great to hear. We see a lot of different types of models there, but yeah, I like your statement that the capital market is highly efficient, and there's also plenty of capital, right? So, and the synergy or the strategic synergy between startup and corporates is where huge value can be created, right? So, maybe go right back to kind of some of the questions that's been posted. I think you were just last talking about the working with startups, and there was a question on how you kind of work with some of the startups, particularly in terms of the area of piloting, and then how do you use pilot as a way to deal with risk aversion? I don't know whether you can maybe expand that on just a little bit on that topic. Yeah.
Sure. Yeah. So we try to there are two kinds of partnerships that we form. One is something that we might use ourselves. Let's say a cybersecurity startup that has a new solution that we want to deploy on our internal system, to improve the security of our own IT. That's an easy one to pilot, right? And I think that's probably not worth spending time on. The more interesting one then becomes how do we create something that we then pilot to our joint customer, and that's something which what we do is find target customers. We segment our customers by those who are early adopters and open innovation, and this could be a a tech company or even an oil and gas company that really is looking for innovation, and it may not be a highly regulated utility that really can't really accept anything new easily. So we segment our customers. We find the customers that are very open to innovation, they're open to piloting, and then by industry and by customer type. So when we have a proof of concept or a pilot, we can then take it to them jointly, and we do one of two things. We either go in under the Schneider umbrella and say, this is a Schneider solution that we're piloting, and we might hide the startup by agreement, by joint agreement with the startup, but we hide the startup from that customer interaction. Or we might go in with sort of full transparency of, we'd like you, Mr. or Ms. Customer, to pilot this solution. We're thinking about using it in our overall portfolio, but we haven't, we would like to test it first. The startup is really doing some great things, and we go in together. And we have sort of a partner agreement with the startup, so that if it is successful and it leads to something bigger and better, then we are all the agreement, and what happens next is well documented in that agreement, including IP and including revenue share and all that kind of stuff. So we have that sort of defined so that if successful, we know what happens. If not successful, we know what happens, and that's a key part. And the other key part is this willing customer who is willing and ready and able to do pilots with us.
Yeah, that is so important. I call basically before you start the pilot, I think it's really important to have ironed out if the pilot is successful, what happens, right? If the pilot is not successful, what happens? And I've gone through lots of pilots where after negotiating, and it gets really complicated at that point. So no, that is great best practices here. I'd like to switch to another question. I think it's a great question, which is how do you manage the differences of workflow and cultures between a startup and a corporation?
That's really because in this walled garden, in this accelerator environment, that's how we sort of buffer the startup from the corporate machine and vice versa. So we try not to scare our lines of businesses too much by exposing them to too much of what's going on. So we sort of buffer that a little bit, and that really helps a lot. What we have seen, we've seen some startups really struggle, almost go out of business because our process was just too slow and cumbersome because it was really core, highly regulated business. We had to go through UL certification, we had to go through testing, everything, and it was really and the startup was really struggling. But thank God they survived, and now we're going to have a great solution together. So it's challenging. I don't think there's one easy approach, but we've found this model of the accelerator to really help buffer it. And
I think this walled garden is great in terms of basically during that phase of that relationship. But what happens when, let's say, that phase is move on to the next phase where we really start integrating the business and start growing the business? How do you handle the differences of culture then?
Yeah, it's a great point. By then we've done a couple approaches. One is that we've just kept that as a separate business, and we've incubated it, sort of centrally, even after it's gotten out of the accelerator. We incubate that business. We call it an independent operating unit, and that sits inside the line of business, but it doesn't get absorbed and integrated into the line of business, and that works. That's a good model. We've also, however, brought things in, and we've integrated them in, and we've absorbed the solution into our stack, and we begin selling it. I think that after you come out of the accelerator, we know enough, and everybody is much more clear on why we should do this, and the lines of business leaders and the teams and the go-to-market teams and the supply chain teams, have a good sense of of the mission and why it needs to work. So I see that actually not as big of an issue as one might think, because when you're seeing billions of dollars of growth right around the horizon, everybody gets pretty excited. So it works out. It cuts through some of that resistance and culture clash. But really, probably the biggest, if you talk to our startup partners, the biggest complaint they would have is that we're not moving fast enough, and that's, so we still got room for improvement there.
Yeah,
hey, Kanis, I want to go back to this incubator, this accelerator model, because one of the biggest questions that we hear many times is, do you do that inside, or do you do that outside? So maybe instead of having a walled garden team inside the company, maybe you should have a walled garden team outside the company and just have that done externally. And I think there's a very healthy debate and a question that we are certainly exploring. But this, how do you scale this model inside or outside the company, and what's the most effective tool? I think both are very effective. In our experiences, both are very effective, but don't have a great answer there on how do you really scale and do it in a big way. So you probably have to do a little bit of both. But anyway, I just want to come back to that point.
Sure, I think that's a really important point too, where at least the rocket space model, it's basically we have a very structured program and a regular cadence, and also work with a number of the reason we call corporate collaborators. The reason I would say that is that I think when you bring a number of corporations together, they're really partners in the value chain, where we found that to be very effective. Then I call you get a synergy even among the corporates, where I call you get 1 + 1 = 10, right? So now the corporates have a way to look at the whole value chain, and the startup is heavily motivated because now they can look at the solution not in the context of a particular individual corporation, but basically it's in the value chain and industry, right? And it can really move the needle and get into a very regular cadence structure where we see innovation is ongoing, continuous, right? It's not that you do one program and you're done. In fact, it's a journey that never stops. And then once you get into it, it just keeps going and going, and this gets everybody in that process, if you will. I know we're closing up on time here. Maybe one last question, Paul, which is I think a really important question, which is, how do you measure success? How do you look at the ROI of your investment?
So we, in the first year, it was just number of deals done. So we were just tracking the number of partnerships, and so it was we were just measuring activity. Now we're starting to look at those partnerships and understand how much revenue is being generated, how much cost down is happening, or how much innovation, PR value we're getting from the partnership. So I have a revenue target for this year. I have a cost down target. I have a number of partnerships formed. I have a number of investments. We actually or acquisitions. That's part of our program. So last month we announced that we purchased a startup that we had been working with for about a year. Last year we did investments. We'll probably do more investments this year. So that's also kind of part of my responsibility is with these startups is to figure out what comes next after this initial success. How do we strengthen and formalize and expand the partnership through investment, acquisition, or just scaling up. So, but those are the key things that we measure.
Great. Thank you so much, Paul. And I really, really appreciate all your insights and wisdom here and your time. So I want to now turn it back to Chris.
Terrific, Kanis. And again, thank you both, Paul and Kanis, for this insightful Q&A and discussion on collaborative innovation. Some quick reminders to everyone that's here. Again, we are recording this webinar, so we will send you all a link along with a copy of this presentation. Again, we are hosting a series of webinars on innovation, so I'd encourage all of you to monitor your inbox, sign up for our next one, which is coming on March 22nd, talking about more leadership of open innovation with Paul Sloan. If you also would like to get in touch with Paul Campbell, here is his contact info. You can email him at paul.campbell@schneider-electric.com. And Paul's dropped his email into the chat there. So again, thanks, Paul, for your openness, for sharing all of these insights with everyone. Hopefully all of you in attendance have gotten something of value today. And you've also had an opportunity to learn about rocket space. So do look out for your free copy of the disruption report from Rocket Space. And do feel free to engage directly with Rocket Space, contact them, learn more about how they might be able to help you with initiatives within your organization. Again, I'd love to thank all of our speakers and all of you in attendance for taking time out of your busy day. Hopefully you've had some great insight that you've been able to put into action, at least one thing that you can put into action to, make some changes this year. Again, thanks everyone for attending. Paul, Kanice, thanks for joining us today. Have a great day, everyone.
Thank you, Chris. Thank you, Kanice.
Thank
Bye-bye.
you.
Thanks, everyone. Have a great day.